Welcome to this explainer. Today, we're unpacking the foundational wisdom of the world's absolute most successful value investors, Warren Buffett and Charlie Munger. We're going to explore the core principles that transformed a struggling textile mill into a $500 billion juggernaut. So if you want to understand how the greatest investment team of all time actually thinks, you're definitely in the right place. To do this, we're actually using our textbook for the day, Daniel Pecaut's brilliant book, University of Berkshire Hathaway. What Pecaut and his partner Corey Wren did is pretty amazing. They attended Berkshire's annual shareholder meetings for 30 solid years, feverishly taking notes to capture the essential meaning and intention behind Buffett and Munger's strategies. So today, we're going to use their hard work to distill decades of complex annual meeting notes into clear, actionable insights for you. All right, here's the syllabus for our masterclass today. We're looking at 1. The ultimate investment university. 2. Building a compounding machine. 3. Value investing core principles, and 4, lessons from the 80s. Okay, starting with section 1, the ultimate investment university. Let's see exactly why Pecaut enrolled in this masterclass, and why we should too. You know, early in his career, Pecaut learned the hard way. He tried his hand at short-term option trading. It sounded great, right? Quick money, fast action, theoretically tripling your money in no time. But after spending a whole frustrating year attempting to trade options, he actually sat down and calculated his profits against the time he spent. He realized his return on time was literally a dismal 10 cents an hour. Just 10 cents. Talk about a wake-up call. It was a complete waste of effort, and it prompted an urgent search for a radically better approach, which led him straight to Warren Buffett. And that shift changed everything. Now, look at this. The sheer magnitude of their outperformance is just staggering. I mean, to justify the risk of owning Berkshire over a simple index fund, it has to beat the general market, right? Well, mission accomplished. Over 5 decades, from 1965 to 2014, a single dollar invested in Berkshire saw a gain of over 750,000%. They beat the general market by nearly double the compounded annual rate, largely because of a strict don't-lose philosophy that fiercely protected their capital during market downturns. But wait. It gets crazier. This wasn't just some one-off fluke that started with Berkshire. Even before taking over the company, Buffett's early partnership was already compounding at a staggering annualized rate of 25.9%. To put that into perspective for a second, he took a $10,000 investment in 1956 and turned it into $200,000 by 1969. And he did the whole thing without a single down year, even though the broader market had 6 down years during that exact same period. Superior returns below average risk. Incredible. Moving right along to section 2, building a compounding machine. How did they actually build this legendary wealth-generating vehicle? Well, it didn't start as a powerhouse, that's for sure. It actually evolved from a struggling, deep-discount New England textile mill. Buffett took control in 1964, and honestly, it was a business in terminal decline that he didn't even know how to run. But he smartly used it as a corporate shell, a publicly traded base with permanent captive capital. Then, he shifts gears entirely. He buys an insurance company, National Indemnity in 67, scoops up high-quality brands like See's Candy in 72, and boom, the struggling mill transforms into a massive insurance and consumer brand juggernaut. And the absolute engine behind that juggernaut, it's a little thing called float. Listen, if you don't get float, you simply don't get Berkshire Hathaway. Charlie Munger basically calls this their one big thing. Think about it. When you buy insurance, you pay your premiums up front, right? The insurance company holds onto that massive pile of cash to pay out future claims. While it's just sitting there waiting to be used, that's the float. So they took that concept and literally changed investment history in 3 simple steps. First, they collect those premiums. Second, they hold those reserves, generating this massive low-cost float at about a 3% cost. And third, Buffett and Munger take that money and invest the proceeds at something like a 13% return. By investing $1.50 for every dollar of actual capital over the years, they engineered a self-sustaining compounding machine that highly leveraged their returns. Which brings us to section 3, value investing core principles. Let's look at how they actually apply Ben Graham's teachings to invest that float so successfully. So Ben Graham, the father of value investing, broke the complex art of investing down into 2 super distinct variables, price and value. It sounds basic, but value is what a business is actually worth, and price is simply what you have to pay to get it on any given day. At its absolute core, Buffett and Munger's entire strategy is built on exploiting the gap between those 2 numbers. When the manic depressive stock market goes a little crazy and acts irrationally, they swoop in and buy $1's worth of actual value for like 50 cents. But here's the thing. Buffett didn't just blindly copy Graham. He evolved the whole method. Instead of just looking at the hard, quantitative numbers on a balance sheet, Buffett searches for what he calls intrinsic business value. And this uniquely includes the fuzzy stuff, the intangibles that don't easily show up on a spreadsheet. We're talking immense franchise power, fierce brand loyalty, and elite management talent. Their unique brilliance in identifying those intangibles is exactly what sets Berkshire apart from the rest of the Wall Street crowd. And you can't talk about intrinsic value without talking about this amazing bridge analogy. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That brilliantly illustrates their massive margin of safety. You're not aiming to buy a dollar value for 97 cents because one tiny mistake and you're wiped out. You demand a gap so dramatic that it absorbs all your bad luck and inevitable miscalculations. You build in structural safety so you can sleep like a baby at night. All right, Section 4, Lessons from the 80s. Let's anchor all this theory and reality by looking at their strategic moves during the euphoric bull market of the late 1980s. Picture this, it's in 1987 and Wall Street is just totally gripped by sheer euphoria. Stock prices are going to the moon. Buffett and Munger look around and see these wild extremes. They specifically noted that the rewards to owners had become gloriously uncoupled from the plodding performances of the actual underlying businesses. Because the intrinsic values of their holdings were now fully reflected in the soaring market prices, they didn't hesitate. They completely sold out of their non-permanent stock positions, moving a massive $1 billion safely into 8 to 12-year tax-free bonds. Now, to be perfectly clear, they weren't trying to magically predict our market crash. They were just reacting to the gap between price and value. As Buffett famously put it, we simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. It perfectly captures how they handle the super contagious market diseases of fear and greed. They completely strip the emotion out of the equation and act only on the cold, hard mathematics of intrinsic value. During those same meetings, they also tackled macroeconomic forces, like inflation, and they were very impartial about it. They warned that inflation is largely a political phenomenon, rather than a strictly economic one. They viewed it as an irresistible short-term narcotic for politicians who have the power of the printing press. And because of that structural temptation, they advised that fixed-income investors need to be incredibly careful, which is exactly why Berkshire limited its own bond exposure to shorter maturation windows. So, what's the ultimate takeaway here? Looking at their specific behavior during these pivotal years provides us with a really clear roadmap. Seek out enlightened common sense. Demand that huge margin of safety. Completely ignore macroeconomic forecasting. Seriously, ignore the fancy graphs. They don't change intrinsic business value. And above all, stay profoundly humble. Knowing your own limitations is the true gateway to understanding. As we wrap up this explainer, I really want to leave you with a challenge. Take a hard look at your own decision-making process. Ask yourself, are you building your portfolio on the manic mood swings and the fear and greed of Wall Street? Or are you truly acting like a student of the University of Berkshire Hathaway, relying entirely on intrinsic value, extreme rationality, and an unbreakable margin of safety? Honestly, the choice you make right there might just be the most important financial decision of your life. Keep learning and keep compounding.